Hello, Chapter 11, International Banking and Money Market. So this chapter is about the international bank and the money market. So we will introduce the banking system. It's similar to the domestic, but there are some special features about the international bank. So introduce about the internet banking system, and then the security in the money markets, and finally talk about the risk that international bank may face. So starting with the international banking services, international bank do everything as domestic bank do, and they add some features, some more features. I mean, one of the most important things that international banks do is the arranging the trade financing. The trade should be done internationally. So they're arranging the trading finance, and they also arrange the foreign exchange. Two very important features. And then they also offer the hedging service of the foreign currency receivable and payable through the forward and option contracts. They also offer international banking services if it is allowed. So why we do the international banks? This actually, so there are 10 reasons that the Ruckman and Kemath in 1987 provide this list, the formal list of that. So first reason is the lower margin cost. So these knowledges, like the managerial knowledges, market knowledges at home country, maybe also used abroad with lower marginal cost. That's the first reason. Second, knowledge advantages. The foreign bank subsidiaries can draw on the parent bank knowledges of personal contract credit investigation for use in the foreign market. So if the bank is internationally run, then they actually use the knowledge knowledge learned in the parents' usually more developed market, and then they actually use this knowledge in the foreign country. 3, home nation information service. It is local firms in the foreign market may be able to obtain more complete information on trade and financial markets in the multinational banks home nations than is obtainable from the foreign domestic bank. So these banks has more information because they run banking services in many different markets. So domestic banks do not have enough knowledge. Maybe the firm may learn more from foreign bank, international bank. Prestige. Very large multinational bank has high perceived prestige, such as the big bank, Citibank, Deutsche Bank. Deutsche Bank is not a commercial bank, however. I mean, Goldman Sachs is another investment bank, like Bank of America, Wells Fargo, like Swiss banks, such as UBS. Many international banks actually very prestige is attractive to the new client. Regulatory advantages. Multinational banks, international banks are often not subject to the same regulation as domestic bank because they run a business international and their home country is outside of the foreign country. Some countries have very strict banking restrictions. Then they actually avoid this regulation by running internationally. Wholesale defensive strategy. Bank follow their multinational customers abroad to avoid losing their business at home and abroad. So the strategy that they may use. Retail defensive strategy is the multinational bank also compete for retail services, such as a traveler check, the tourist market and foreign business market, many retail markets. Transaction costs may be lower, because it's multinational, so, and also they may be available to, circumvent government currency controls. Growth, foreign market may offer more opportunities, and not just domestically. You can grow internationally. And risk reduction, the greater stability of earning is possible with the international diversification. Offsetting business and monetary policy cycle coordination reduce the country-specific risk a bank faces if it operates in a single nation. Okay. So these are types of international banking offices. We're going to see one by one. Okay. The first one is the correspondent bank. So the large bank in the world will generally have the correspondent relationship with other banks in all major financial centers in which they do not have their own banking operations. So this relation exists when two banks maintain deposit with each other. For example, the large New York bank will have correspondent bank account in London bank, and London bank will maintain one within New York bank. So they don't have to have own bank in London or New York, but they use the correspondent bank to smoothly run a business. So this system enables a bank, multinational clients to conduct the business worldwide through his or her local bank or its contacts, right? So that's, if the bank has to have all branches in the market, in international market, is very, very costly. So instead, they actually start a relationship with another bank in international cities, like the foreign country, and they have correspondent banking relationship. Representative offices. Representative office is a small service facility staffed by parents bank personnel designed to assist multinational clients of the parents bank in dealing with the bank correspondence. So they set a small service facility. They have parents bank staff help the client, because the clients basically hire this the bank, international bank. So even though they have the correspondent banking relationship with other banks, they should usually have the small offices that help these clients. The parents bank may open a representative office in a country where it has many multinational company clients and at least an important client, such as if you have big client, so if the international banks has a big client in China, then they can open the representative office in China, and then they help the client, and they have the correspondent banking relationship with Chinese bank to run their business, to help their clients. The representative offices also assist the multinational company clients with information about local business practices, economic information, and credit valuation of the multinational company's foreign customer. So they provide like a more detailed service to the multinational company's client. Foreign branches. So foreign branches operate like the local bank, but legally it is part of the parent's bank. The branch bank is subject to both the banking regulation of its home country and also foreign country too. US branch bank in foreign countries are regulated from the United States Federal Reserve, the regulation or the act, but they also have to fully follow the regulation in the foreign countries too. There are several reasons why the parent bank might establish the branch bank, the foreign branches. The primary reason is the bank organization can provide much fuller range of services for its customers, usually multinational companies, through a branch offices than the representative office. The branch is like local bank. Example, a branch bank loan limits are based on the capital of the parent bank, right? Not the branch bank. So a branch bank will likely be able to extend the large loans to the customers than the locally subsidiary bank of the parents. Additionally, the book of the foreign branch is part of the parent bank's book, so financial accounts. Therefore, the branch bank system allows customers much faster check clearing than does the correspondent bank network, because they use its own network to clear the check and everything. It's internal process. Another reason is they try to compete on the local level with the bank of the host country. Branches of the US bank are not subject to the US reserve requirements on deposit and are not required to have the Federal Deposit Insurance Corporation, that's FDIC insurance. FDIC is the insurance. It's requirement for the banking in the United States, but foreign branch, no. Therefore, the branch bank are on the same competitive level as local bank in terms of their cost structure in making loans. So this branch banking is very popular way. So it's actually most popular way for US bank to expand operation internationally. Most branches located in Europe, particularly in the United Kingdom. And many branch banks are operated as shell branches in offshore in banking center, and a topic covered later on this chapter actually. Subsidiary and affiliated bank. So subsidiary bank is a locally incorporated bank. So they are incorporated in local, like the foreign country. If they're wholly owned or owned in major part by a foreign parent. An affiliate bank is the one that is only partially owned but not controlled by its foreign parent. So it's a little different. The subsidiary is a locally incorporated, it's wholly partly owned by foreign parents and controlled by them. Affiliate bank, not controlled. Both operate under the banking law of the country where they are incorporated. Foreign-owned subsidiary banks in the United States tend to locate in the state that are major center of the financial activities, as the US branches of foreign banks. In the United States, foreign bank offices tend to locate in highly populous states, New York, California, Illinois, Florida, Georgia, or Texas. US parent banks, like the foreign subsidiaries, because they allow US bank to underwrite securities. At bank. They are federally chartered subsidiaries of a US bank, physically located in the United States, and are allowed to engage in a full range of international banking activities. So Federal Reserve Regulation K about international banking allow these act banks to accept a foreign deposit, extend trade credit, finance foreign projects abroad, trade foreign currencies, and engage in investment banking activities with United States citizens involving foreign securities. They do not compete directly with services provided by US commercial bank though. An act bank is typically located in a state different from that of its parents to get around the prohibition in interstate branches banking. However, since 1979, the Federal Reserve Act has permitted interstate banking by act bank. Act bank are not prohibited from owning equities in business corporations, unlike domestic commercial banks. Therefore, it is through act that U.S. parent bank has historically owned foreign banking subsidiaries and held ownership position of the foreign banking affiliates. Offshore banking center. So offshore banking center is a country whose banking system is organized to permit external accounts beyond normal scope of the local economic activities. The International Monetary Fund, which is IMF, recognize the Bahamas, Bahrain, the Cayman Islands, Hong Kong, St. Martin, Panama, and Singapore as a major offshore banking center. Offshore banks operate as branches or subsidiaries of the parent bank. The principal features that make the country attractive for establishing offshore banking operations are virtually total freedom from host country government banking regulation. They try to avoid the regulation, and they set up branches or the subsidiaries actually in offshore banking center. And for example, low reserve requirement is attractive, and no deposit insurance, so they don't have to pay. Low taxes, favorable time zone that facilitates international banking transaction, and to a minor extent, strict banking secrecy laws. So they can avoid strict regulation. They can save the cost. So the primary role of these offshore banks is actually to seek the deposit and grant loans in currencies other than the currency of the host government. Okay. So there's called the shell branches. So shell branches, which needs to be nothing more than the post office box in the host country, actually. So Federal Reserve authorized the US bank to establish these shell branches. And the actual banking transaction is done by parents bank. The proposal was to allow smaller US banks the opportunity to participate in the growing Eurodollar market without having to bear the expense of setting up operations in a major European money center. These days, there are hundreds of offshore bank branches and subsidiaries. About 1/3 operate by the US parent bank. Most offshoring banking centers continue to serve as location for shell branches, but Hong Kong, Singapore have developed into full-service banking center that now rival London, New York, Tokyo. In 1981, the Fed authorized the establishment of these international banking facilities. It's called IBF, International Banking Facilities, IBF. This IBF is a separate set of asset and liability accounts segregated on the parent's bank of asset and the liability accounts. I'm sorry. So IBF is a separate set of asset and liability accounts segregated on the parent's bank book. It is not unique, physical, or legal entity. Any United States chartered depository institutions, a U.S. branch of subsidiary of the foreign bank, or the U.S. office of an act bank may operate this IBF. IBFs operate as foreign bank in the United States. They are not subject to domestic reserve requirement on deposit. They are not subject to also to have the required to have the FDI insurance for the required deposit. Actually, IAFs try to find the deposit from the non-U.S. citizens and can make loans only to foreigners, not to the citizens. All non-bank deposit must be non-negotiable time deposit with a maturity of at least 2 business days and be of a size of at least $100,000. This is organizational structure of the international bank offices from the United States perspective. So you can see these type of bank and the location and the jobs they can do. Good table to see actually. So check with this table. What is the biggest concern that bank regulators and depositors have? It is safety of the bank deposit, all right? So bank capital adequacy refers to the amount of equity capital and other securities a bank holds as a reserve against a risky asset to reduce the possibility of a bank failure. So we have so-called the Basel Accord. It's agreed in 1988, and this accord is set after a Swiss city in which it is headquarters. So Basel Accord is basically named after the Basel, the name of Swiss. Headquarters is here. Bank for International Settlement, BIS. So BIS is located in Basel, so we call it Basel Accord. This BIS established a framework for measuring bank capital adequacy for banks in the group of 10, G10 country and Luxembourg. The BIS is the central bank for clearing international transactions between the national central banks and also served as a facilitators in reaching international banking agreement among its members. Now, Basel Accord called the minimum bank capital adequacy. So there's a minimum capital requirement. The ratio is typically 8%. Okay, 8%. So it means that the international bank needs to have at least 8% of the equity relative to the risk-weighted asset for international active bank. This accord divide bank capital into two categories, tier 1 capital and tier 2 capitals. Tier 1 is the core capital, shareholders' equity at the retained earning, And tier 2 capital is the supplementals, international recognized non-equity items such as the preferred stock and the subordinated loans. Supplemental capital, the tier 2 capital could count for no more than 50% of the total bank capital, or no more than the 4% of the risk-weighted assets. Okay. So traditional bank capital standards protect depositors from the traditional credit risk. They probably not very, it's not very sufficient, especially if they want to get protection from the derivative risk. So there's another accord, called the Basel II Accord, has been endorsed by central bank governors and bank supervisors in the G10 countries, again, plus Luxembourg. And this set of details for adopting more risk-sensitive minimum capital requirements. Okay. The key variable the bank must estimate are the probability of the default, that's important, and the loss given default for each asset on the book. So based on this Basel II Accord, they basically should follow the rules, usually the minimum requirement, capital requirements. And if they do not satisfy these standards, then it's very hard for these banks to run a business internationally. Okay. So this is part 1 of the chapter 11. Now, next part, we'll see the international money market securities.